Hello traders. Some of you expressed interest in learning technical analysis, and I have decided to upload a few tutorials to help you get started. These first tutorials will cover the basics of TA, such as identifying support and resistance levels, candlestick patterns, and market structure. In the future, I will upload more advanced lessons on the Wyckoff theory, order blocks, Gann concepts, and more. Some of you are advanced traders and may be already familiar with these concepts. If you are, please stick around regardless. You are never too advanced to go over the basics of your craft. Also, your comments and pointers could be invaluable to me and others watching this video. Before we begin, every concept has some nuance. However, in the interest of simplicity and clarity, I will not get into the fine details. If you have any questions or comments, please write them in the comment section and I will get back to you as soon as possible. If it's a complex issue, feel free to email me. My email address is in the YouTube bio. The first tutorial is about market structure. Now, why is market structure critical? Because the fundamental issue you need to understand is the market's direction. Are we going up or down? If you know the trend and trade accordingly, your success rate will be much higher. If you trade with the trend, success is just a matter of patience and risk management. I will explain each subject, and after I've explained it, I will show you chart examples. If anything is unclear, again, write it in the comments or email me. This video will include timestamps. The purpose of the timestamps is to make it easier for you to go over the lesson the second or the third time. I'm asking for your patience. Please don't skip any part of this video. Okay, so let's begin. First, terminology. We need to have an agreed common language, and this common language will serve us when we will discuss more intricate chart patterns and more complicated subjects. First, we need to get the basics right between us. Okay? Now, you may be familiar with some of these terms because they sound very basic, but I'm asking for your patience. Please don't skip this part. Let's go over it together and over the chart examples. And if there's anything not clear, or maybe you don't agree with my opinion or with my the way I present things, that's fine. You can write it in the comments, and I promise to read it, go over it, and if something needs to be changed, it will be changed. Now, to trade market structure patterns, we define a change or continuation in market structure using these terms: high, higher high and higher low, low, lower low and lower high, change of character, and break of structure. Definition of a high. Please pay attention to what I say here, because I use the closing price and not the wick to determine a high or a low. The reason I'm referring to the closing price will be made clear after I show you some examples. Now, having said that, I don't consider anything I say as gospel. Sometimes, if the situation warrants, I will use the wicks. Remember, nuance, okay? Definition of a high. A high is a candlestick pattern, not a single candle, that involves at least 3 candlesticks. In the case of a 3 candlestick pattern, the middle candle must have a higher closing price than the candles before and after it. higher high. A higher high is the same candlestick pattern as the high. The only difference is that the closing price of each candle in this pattern is higher than the prior high. A lower high, again, the same candlestick pattern. The difference is that every candle in the candlestick pattern in the lower high has to have a lower closing price than the previous higher high. Okay, let's show one example, and maybe everything will be clear with this example. Look here at this green candle next to the dashed vertical line. What's the closing price of this candle? It doesn't matter the exact number. The thing to understand is that the closing price of this candle is higher than the one on the left and higher than the one on the right, which makes it a high. But trading is not as simple as you might think, because let's go over one candle. Let's look at this candle. The closing price of this candle is higher than the one on the left and higher than the one on the right. But the one on the right has a higher wick. Okay, so which price will we consider as a high? If we are taking the closing price into account, this is the high, and we have actually two equal highs, which we will classify broadly as a high, just a high. Okay, let's move over to this candlestick pattern. This is a higher high. The middle candle, the green one, has a higher closing price than the left one and the right one, but you can see that the wicks here, 1, 2, 3, they're all higher than this candle. Okay, but I classify this as the higher high, this candle. Okay, now why don't I use the wicks? It will all be made clear to you in a second. This is a chart example. This is the BNB chart. Look at the difference between the line chart and the candlestick chart. You see, this candle here has a wick which is higher than this high. But when we are discussing market structure, I don't consider the wicks. The wicks are something different. The wicks are more related to liquidity. And liquidity is a different concept. It has different implications. And when you refer to market structure, it is best not to consider the wicks. And if you are inexperienced or you haven't trained your eyes in watching candlestick patterns, then consider the line chart. Consider using a line chart to place the lows and the highs. Lows or low. A low is a candlestick pattern that involves at least 3 candlesticks. In the case of a 3 candlestick pattern, the middle candle must have a lower closing price than the candles before and after it. A lower low. A lower low is the same candlestick pattern as the low. Only difference is that the closing price of each candle in this pattern is lower than the prior low. And the higher low, a higher low is the same pattern as the low or the lower low. The difference between the low and the higher low is that the closing price of each candle in the higher low pattern is higher than the low. Let's go over some chart examples. This is a low and a lower low. It's the same chart, of course. This is a candlestick chart and this is a line chart. Let's go over the candlestick chart. This here is the low. Why is this a low? Because its closing price is lower than the left candle and lower than the right candle. You can see also we have a distinct visible low. Note this wick here on the green candle is higher than this candle, but I am referring to closing prices. And if you examine the chart using a line chart and not a candlestick pattern, it will all be made clear, because you can clearly see that this is the low and this here is the lower low. Okay? This here is another illustration of why I prefer to use the closing price when we are discussing market structure. This here is the same asset. These two charts are the CASPA chart. One is the futures chart and one is the spot chart. And you can see that on the futures chart we have a wick going down. Where did this wick go to? This wick went into this order block, and this was a liquidity grab or a liquidation cascade. When you examine the spot chart, you don't see this low, okay? And it's important to understand that this wick here didn't change anything in the market structure. So this is why a closing price is the better option. This here is another illustration of why it is more appropriate to use the closing price and not the wick when we determine market structure. This here is is the same asset. It's ICP and two charts. This is the Binance chart. This is a different chart. And you can see that on Binance the high is 2,831 and here it's 371. Why is the difference? Because there was some liquidity event in the past here on ICP's price action. But as far as market structure goes, I think everyone understands that ICP will not be evaluated at $2,831 anytime soon. Okay? Now, this is the near chart, and what I want you to see here is that charts are not easy to read and to understand. Now, when we are trying to determine a high, a low, okay, market structure, you don't need to get into every three candlestick charts, every three candlestick pattern, and define this as a low, this is a high, higher high. No, you just go, okay, and look at it, big picture, distinct low here, high, distinct high here, higher low, higher high, higher low, lower high, lower low, lower high, okay, lower low. We are going from an uptrend to a downtrend. Okay, now if you get too much bogged down in the details, you will miss the forest from the trees, and that's not the intention. Okay? Finally, we are at the meat of this presentation, three market structure patterns. Every market goes through three stages. These stages are cyclical, and they repeat themselves in every market, in every time frame, and in every asset. These patterns are an uptrend, a downtrend, and sideways movement. Definition of an uptrend. The uptrend is a chart that makes higher lows. Note that the definition says nothing about the highs on the bars. An uptrend occurs when the demand for an asset is greater than the supply. It shows unsatisfied buyers in competition with each other, so they keep raising prices to higher levels and creating a higher low pattern. Now, intuition and even common sense suggest that the definition of an uptrend will be higher lows and higher highs. And there is a point why I use the textbook definition of higher lows. Higher lows are a manifestation of rising demand. Rising demand is a cause, and the effect will eventually create higher highs. But if you find it confusing, it is okay to use higher lows and higher highs as the definition of an uptrend. Downtrend. Definition. A downtrend must meet two criteria to confirm its validity: a series of lower lows and a series of lower highs. Each low must be lower than the preceding one, and each high must be lower than the previous one. Let's go over this chart example and why I chose this chart example. Simply to demonstrate a point that when we are talking in a classroom setting, everything is easy to understand. Look here, we have a low, lower high, lower low, lower high. But what happens here? This is a higher low than the previous one. And this high is higher than the previous one. But following this abnormality, or it's actually a normality, the downtrend continues. You need to keep awareness on the higher time frame trend and don't get bogged down in the lower time frames and in the details, because it will mess you up and you can possibly misread the picture. So like everything, like every craft, it takes some experience and discernment to really judge if the uptrend or the downtrend is continuing, or maybe we have a trend reversal, and we will discuss trend reversals and how to confirm a trend reversal in a separate video. Now the same here, the same applies to range, but let's go over the definition. A range market is a corrective phase that occurs when financial markets supply and demand sides disagree. Once the disagreement is resolved, the market will either continue in the previous direction or move in the opposite direction. In a range market, price moves in a tight range between support and resistance. For example, this is a downtrend. This is Bitcoin's downtrend, January of 2022. And you can see this is a redistribution range. What happened? There was a very severe sell-off, and this severe sell-off created an imbalance and a period of time in which the market was undecided whether that's enough and we can continue going up, or maybe continue with the previous trend, with the downtrend in this case, and you can see that we continued with the downtrend. This here is the Didex chart, and this is an accumulation phase. This is a range movement after making a significant low. And there is a reason why I chose this chart as well, because we have a tendency to think of a range as a fixed resistance line and support line, and the price remains within the boundaries of the resistance and support. But in real life, things don't work this way, and you can see that there were several attempts to break out of the range, which in the end were failed, and the range continued. Why did the range continue? Because the accumulation phase wasn't over yet. So don't treat any deviation above the range as a change in the trend, because for the trend to change, you need to see, let's say, from a downtrend to an uptrend, we need higher lows. And you can see that eventually, maybe you could have said that we got higher lows, but this move failed and the downtrend or the range accumulation continued. Okay? Nuance. Now, two additional terms: change of character and break of structure. What is a change of character? A change of character is a reversal pattern, meaning that a bullish change of character is when a candlestick closes above the previous high. A bearish change of character is when a candlestick closes below an earlier low. And a break of structure is a continuation pattern, okay? Not reversal. Meaning that a bullish break of structure is when the price, or the candlestick, closes above the previous high. A bearish change of character, or break of structure, is when the price closes below the last low. Let's go over some examples. And here, I will remind you what I said about nuance. I used the closing price in the definition, but the chart example shows the change of character line from the wick. Why? Because drawing a change of character line from the wick gives you or me, in this case, additional confidence that this move is real. Now, feel free to experiment and decide what's best for you, because TA is more an art than a science. But let's go over the chart example. You can see that this candle right here, first we had a falling wedge pattern, which is a bullish reversal pattern, and we had this candle, this green candle here, wide range candle, which shows an increase in demand, and the closing price of this green candle here was above this lower high, and we consider this as a bullish change of character, meaning that the market is moving from a downtrend to an uptrend. But this move, of course, is not confirmed, because what confirms a downtrend? Higher lows, okay? Or if you prefer, higher lows and higher highs. And you can see that after such a move, price was in a consolidation period, and once this green candle surpassed this bullish change of character candle, then we consider it a bullish break of structure, and it's an indication of continuation, trend continuation. Does it have to go on from here and keep making higher highs and higher lows? Certainly not. It is often that these moves fail, but that's just part of the business. When you follow the definitions, when you follow market structure, you have a higher chance of success, but you don't have a guarantee. Okay, final example, bearish change of character and break of structure. Look here, we have a high, low, higher high, and the market begins to shift, to move to the downside. Once it closes price below this low, which is the change of character line, and again I used the wick, this is a bearish change of character. But a bearish change of character does not confirm a trend reversal, and I will discuss about trend reversals in a different video. Okay, why is that important? Because look here, what follows this change of character candle? A bounce to the upside, then the downtrend resumes. Once it breaks below this level here, we can consider this as a break of structure, meaning a continuation. But again, a bounce, a drop, and a bounce. The point of this illustration is to show you that you should never take things out of context. You don't judge a market just based on the concepts of a change of character or a break of structure. You need to look at the chart holistically to understand support and resistance level, to understand liquidity, mainly you have to leave the chart to trade it. And we will discuss this issue further in the next videos. That's it for today. I hope you found it helpful. If these videos will be received well by you, then I will consider making additional videos in the future. And that's it. Thank you, and I will see you in the next video.